And so if you can keep in mind that this is similar to a 1031, but provides way more options than the 1031, then that helps you in educating your clients, because most of your clients know what a 1031 is, or they're familiar, or their accountants are familiar. Now, the biggest difference with 1031 and the Deferred Sales Trust, or DST, which commonly you'll hear through the day or the hour on that, the main difference is you don't have those restrictions. If you sell, and the Deferred Sales Trust, or the DST, can be your primary home, it can be investment, it can be the sale of a business, it can be sale of cryptocurrency, it can be any asset in which there is a determined capital gain. So it's not limited to only a primary house. So if you have clients that you want to try and sell their business, this is also a wonderful solution for them to defer those capital gains. And you don't have the restrictions, a lot of the time frame restrictions that you do with anything else. So those clients, one of the other big objections that I was saying before was they don't want to face capital gains, is we don't want to be handcuffed to a 1031 situation. And this is that sales loop, is you don't have those handcuffs. You don't have to be rushed. This is money that's going to be put into a trust, and you're going to avoid or defer those capital gains. So now we're going to get into what is a deferred sales trust, and how do we apply that to creating sales listings. At this point, I will turn it over to Brett.
Chad, thank you so much. And Jeff, thank you so much. A pleasure to meet everyone. So it's going to be action-packed here. We're going to go pretty quick. I'm going to start off with sharing a little quick little video here, which I think will give some good inspiration. Okay, so here we go.
Are you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like-kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career, and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
All right, so here we go. Thanks so much, everyone, for being here, taking the time out to spend some time with me, Chad, and Jeff to learn a little bit about the Deferred Sales Trust. And that's a little intro video. Hopefully you enjoyed that. I'm also going to share my screen to be able to share the presentation here. So let me know. Should be able to see here in about a few seconds. And slideshow. Okay, can you guys see that okay?
Yes.
Okay, awesome. So we're going to be talking about unlocking capital from millionaires using the Deferred Sales Trust to eliminate the 1031 exchange and basically to unlock more transactions. And for those who don't know me, my name is Brett Swarts. I'm founder of Capital Gains Tax Solutions. I'm a Deferred Sales Trust expert. My wife took this picture. I know it looks intimidating. We're at New York, right? I wanted to get one in front of the bull here. So we did this last October when everything was opening back up. And as a legal disclaimer, I'm not a CPA nor tax attorney, although we do work with, I think, the smartest and some of the best in the Midwest to help our clients and with Chad execute the Deferred Sales Trust. So this presentation is for educational purposes only. And obviously, as real estate agents as well, you want to make sure that you're telling your clients to seek independent legal tax advice, that you're not also providing those legal and tax advice. All right, so you need to be careful with that. And as well, our agenda is just basically how to learn how to help your clients defer capital gains tax using a Deferred Sales Trust and not using a 1031 exchange, okay? By the way, not to be confused, a Deferred Sales Trust is not a Delaware statutory trust. A Delaware statutory trust is just another form of a 1031 exchange. In fact, a better name for that would be a Delaware 1031, but they're both DSTs. This is something that's different than a 1031 altogether. But what's going on right now? Well, your clients, they feel trapped. And they're reluctant to sell because of the capital gains tax. Not just the capital gains tax, but also the estate tax, okay? Estate tax has to do with 40% above certain exclusions. Chad and I are working on a deal right now for one of his clients on a $70 million sale. And this gentleman is looking at a huge opportunity to move funds outside of his taxable estate. And being where you guys are located, the opportunity could maybe have never be more important to know about because the problem is so big. And that's just estate tax. Capital gains tax is something around 30 to 50% of their gain, depending on depreciation recapture and depending on what state they live in, where their assets are at. And so a lot of our clients, before they meet us, this is how they feel, and this is how your clients feel, right? They're not sure what to do, and that causes them not to sell, not to list with you. And so every single day, high net worth cryptocurrency, primary home, business, land, investment property, stock. Businesses such as like dentists or veterinarians or optometrists, tech companies, public or private stock owners, anything you can think of, artwork, collectibles, NFTs, they pay hundreds of thousands to millions of dollars in capital gains tax when they don't have to. Okay, so who is a Deferred Sales Trust for? It's important to know that it's for you or your investors or your clients, as long as that particular deal has $1 million net proceeds and $1 million gain per transaction. So it needs to be big enough, okay? Otherwise, it doesn't make a lot of sense. In other words, the pain has to be big enough. So if they have $1 million asset sale, it has at least $1 million gain and $1 million net proceeds, then it's a thumbs up. Although primary homes, you might need a little bit more because you have what's called the 121 exclusion, which gives you 2 of the last 5 years, $250 tax free if you're single, $500 if you're married. So primary home is probably even a little bit bigger. Now, there's a little caveat to this as well. Let's say you had 2 transactions at $500 each, then you could qualify as well. But beyond that, it's too small. So we really want to see 3, 5, 10, 20, $100 million deals here. And then if the client has 2 transactions at $500 each, like let's say $500,000 of crypto and $500,000 of an investment property, we can combine those 2 into one trust. But it works for crypto, NFTs, businesses, again, investment real estate. It can save a failing 1031 exchange. How many of you have clients that say, hey, I'd love to list with you, but I need to have that 1031 lined up. I'd love to list the property, but go find me that deal first. Or I'm afraid of the 45-day 180, right? Or even right now, I have a 1031, but I can't find the property, or the seller's not going to deal. I have a deal today. The gentleman called me and said, look, the tenant that was supposed to be paying the rent on this big retail 1031 exchange went bankrupt, and they're not paying the rent. And I went to the guy for a trade and I said, hey, I'm not going to buy your property at that same price. Half of the rent is now gone. And he goes, so give me a discount. And the guy said, no. And he said, well, there's no way I'm paying it. And he's like, I'm about to pay all this tax. And so we can save a failed 1031 exchange, even if it's past the 45 days, no problem. Even if you haven't identified a property, even if you haven't identified the deferred sales trust, because it's not a property, it's a tax strategy. Now, it also works for GP and LP interest. That's if you're in like a multifamily syndication or different syndications or business ventures. It works for that. Works for primary homes, again, private stock, public stock, carried interest, captive insurance, artwork. But what is a deferred sales trust? And then why do you need one, right? Well, I know Chad covered some of the whys, but we'll go over that as well. Well, first of all, it's just an installment sale. It's based upon IRC 453. It goes back to the 1920s as far as the tax law is concerned. The Deferred Sales Trust is a made-up name. About 26 years ago, one of my business partners, he's a tax attorney, created it and has been building it. And essentially what it allows you to do is to defer tax. It's kind of like an IRA. It's kind of like a 401k. But it's actually an installment sale at its core, which means instead of having to receive all the cash at closing, the seller, your clients, or you become the lender, meaning you can loan funds to the trust and slowly pay tax along the way. You could also think of it kind of like a delayed tax trust, right? You're delaying it. Even like an IRA is sort of like a delayed taxed IRA. Like you're delaying paying the tax. You're able to invest the funds, gross or net amount, not net of tax, just net of the closing. And you can defer 25 to 50% capital gains tax and grow your wealth. Okay. You can also defer income tax. We talked about a backup plan for the 1031. You can also get a new depreciation schedule because you can actually partner with the trust to go buy more real estate or go start another business, all tax deferred. Pretty cool. One of the most important reasons why you need this is because it's called optimal timing. We're going through a very large transition in the marketplace, right? It's happening. We're all feeling it. And people want to be able to sell high and buy low. And if you can't provide something that's going to get them out of the 45-day shotgun wedding, 180-day, marriage, right? It's, 45-day engagement, 180-day wedding. You're looking at the biggest obstacle for your sellers to list and sell right now. And that's where optimal timing comes in because of the deferred sales trust. You can dollar cost average. You can actually put it into stocks, bonds, mutual funds. You can put it into hard money lending. That's part of the diversification and the liquidity that you can have. You can pay off debt. You don't have to stay in like-kind property and also have all this debt. It also can solve, again, the 40% estate tax, which is really cool. And the Monday morning quarterback, one of the best deal stories I know about this, and this is why I'm using this scenario, is a gentleman, and this is really what changed it for me. This is in 2006. And one of the gentlemen that used the Deferred Sales Trust had a property in Minnesota, about a $20 million asset, and he thought that something was going to happen. And his thought was, if I sell, I have to 1031 exchange, but if I can defer the tax using this Deferred Sales Trust, I don't have to overpay for a property. I can diversify a little bit and I can be patient because I think something's going to happen. I think the market's going to shift, maybe even like where we're at right now, where everyone's kind of pausing, holding their breath like, oh no, what's going to happen here? How hard is this going to hit? And so he said the same thing, and he's looking out with his 1031 binoculars. He's like, I'm not doing a 1031 for sure. I'm either going to pay the tax or I'm going to do this Deferred Sales Trust. So what did he do? Did the Deferred Sales Trust. He parked all of his funds at the closing, deferred millions of dollars of tax, and he put it in a diversified investment grade securities, okay? And just waited patiently. You can even just have the money sit in the bank because some people are scared of the stock market. You can wait and be patient with this. You can dollar cost average. You can hedge and protect. A lot of things you can do there. But here's the key. He deferred all of his tax and he kept his money liquid. Okay, 5 years later, that property that he sold was foreclosed on by the bank. And the bank calls him up and said, hey, that property you sold to that 1031 buyer? He said, yeah. He goes, well, we just foreclosed on it. We're curious. Do you want to buy it back? He says, well, maybe. What's the price? And they said 60 cents on the dollar. In other words, 40% less than what he had previously sold it for. So he goes, sure, give me a few days. He was able to reallocate some of those investments and put it into a new LLC and purchase that property back at 40% discount. All tax deferred, by the way. He still hasn't paid $1 of tax, okay? And this is the part where my brain exploded because I'm going, no. I thought you had to stick with the 45 days. I thought you had to do 180. No, you don't. You can sell high and buy low. And that is the Monday morning quarterback, right? That's what everyone would have done. Had we known what would have happened in '08, everyone would have sold in '06 and '07, and we would have dropped back, been patient, and thrown that perfect spiral and bought everything in 2011. Now, we don't have a crystal ball, but at least the Deferred Sales Trust gives us a chance to not feel hostage to these market cycles. In other words, we can diversify, get liquid, and we can buy at optimal timing, and we can become the Tom Brady's, the Peyton Manning's, right? The Joe Montana's. We can be the Monday morning quarterback. Who's the quarterback of choice for you guys? Who's the team? Is it the Packers? Is it the Bears? Is it just college? What do you guys do over there?
Chris.
Grizz. Okay, it's the Grizz. There it is. All right.
We drive a long ways to watch an NFL game.
Okay. How are we doing? Are we feeling pretty good? How's the pace? You guys digesting this? I'm moving pretty quick, I know, and I can also slow it down, but how are we feeling?
Doing good.
Okay, so I'm going to get back to the presentation here, but here's the key. I want you to think about stories, right? Because stories actually will help people to digest this. So that story I just told you, you can go back and watch it again, and it's a real deal that happened, and it's incredible, right? So think about the big picture for your clients, and what's a story that you can tell them to help them relate with what I just said, right? He was reluctant to sell. He was reluctant to do the 1031. He had a huge tax. And he used the Deferred Sales Trust to get optimal timing, okay, and eliminate the 1031 exchange. Minnesota, in fact, his property was across the street from the Minnesota Vikings Stadium, like right around the corner over there. So really nice piece of property. He sold perfectly, okay? So my goal for this presentation, and Chad with me, our goal is to help you grow your business with the DST using the Deferred Sales Trust. Even if you don't have any capital gains tax deferral knowledge, and I'm sure you guys have some 1031 knowledge and have some knowledge already. You're working with Jeff, and you guys are doing great. But you probably are not CPAs or tax persons. I understand that. Like, I'm going to help you just keep it real simple. And also how to use the Deferred Sales Trust to win new listings right now and help buy-side commercial real estate conversions immediately, okay? So as a quick background for me, I'm a former multifamily agent at number one largest national commercial real estate brokerage firm specializing in real estate investment services. I'm a current multifamily broker right now. I have experience with 1031 exchanges, Delaware Statutory Trust. I've closed those, of course, both of those, and of course, Deferred Sales Trust. I've also held my Series 22 and 63 license, but it wasn't always that way, everybody. Like, this was me in 2006. Actually, I wasn't Leonardo DiCaprio closing people on my cold calls. I was one of the guys in the back, like, scratching my head, like, how are these people doing this? Like, how are they making all this money? Like, and I was scared, I was afraid, I was new, but I was hungry, right? In my first year in the business, my cousin was closing these deals. I'll never forget the $98,000 check that my mentor and manager at the time was walking by. He's like, hey, I'm about to give this to Nick, and I want to show you this because this will be used someday. And so I was one of the guys figuring out how are these guys closing these deals, and I wanted to grow. I was all excited. I just graduated from college. I was newly married, or about to be newly married. This is 2006. I was still in college, actually. And I was getting everything going. I played college basketball. I'd been successful. And growing up, I grew up in the real estate business with my parents, and things were pretty good for a while until they got divorced. And when they got divorced, wealth went from, like, my dad had all the wealth and he didn't really pay my mom any child support until, like, my brother and I and our mom living, with lower income. And so wealth for me was like, okay, I saw both sides. I didn't want it to come in between, my family, and I had all these kind of these things. And so I wanted to be very successful. I wanted to be successful in real estate. I was all excited, all motivated. So I'm learning, and I'm getting some momentum going. And all of a sudden, as you guys probably know, the 2008 crash hit, right? And I went from making like a little bit of money to like no money. Now here's the crazy thing, right? I got married, and the marketplace kind of fell apart. And all of a sudden I found myself in a situation where, like, oh no, like, not only was I making just a little bit, but it's 100% commission, no benefits, no salary. Everyone's saying, what are you doing? You're newly married. Now there's a baby on the way. What are you going to do? And I'm going, well, I love the business and I'm not sure what I'm going to do, but let me call my brother, see if I can move into a small condo with him and work a side hustle at a place called Cheesecake Factory. And that's basically what I started to do. So I literally would make cold calls by day to keep my Marcus and Millichap brokerage career going. And by night, I'd start Cheesecake Factory. And this was literally my manager here with the tie on. Now, this was me, not actually me, but that was what I had the same tie on. This is the guy kind of looks like me, okay, on the background. but I would serve cheesecake at nighttime. This is like 70-hour weeks, nights and weekends, and just to be able to keep the dream going. Now, I was going through this struggle financially, so were my clients. My clients not necessarily going to the Cheesecake Factory, but they were losing half or all of their wealth over the next 2008, 2011. And the thing that we could identify, and they were fighting with the banks, was they had too much debt, not enough liquidity, not enough diversification. And the biggest thing was the 1031 exchange was not their friend, because you see they had overpaid in 05 and 06 and 07, and now all of a sudden everything stopped. And so what do you do? Well, we decided to try to figure something out. And by that, I mean, we were willing to bring people in to coach us and to help us. And so one of my business partners, his name is Robert, actually played for the 49ers. He came in, and he's a financial advisor. He came in, he spoke about the Deferred Sales Trust. And all of a sudden I'm going, whoa, there's a whole nother way to do this. And so I started to apply the strategy, and I started to talk about it. People said, it seems too good to be true. It seems like I would have known about it. Call me when you close the deal, or all of these things, or call me 5 years ago or 3 years ago when the market didn't crash, or call me when my market it's back. But I knew it was the future. And I just kept thinking, if I could just help people, I can really grow my business. I can retire from the Cheesecake Factory, and my wife and I can buy our first house, all of those things. And so I started to do that. I started to talk about it. I started to get more listings, more opportunities, be in front of more people. And this is the result now. What's possible now? My wife and I have 5 kids. We live in Sacramento, California, and I speak and coach all over the country. In fact, I met Chad up in Washington at a conference. In fact, this one with the windows in the back where I'm speaking, Chad's at that conference there. And now I have a podcast, and I have a book coming out with Kevin Harrington from Shark Tank. He'll be in the book. But I share that because it wasn't always pretty, right? And it wasn't always easy. And I started from literally nothing when it came to being a tax professional, right? Or an expert in deferred sales trust, right? But after 10 years, I discovered the hard way, right? The 10,000 hours in my mind. And I mean, how many of you want to learn the easy way, right? I want to try to download in the next, 20 or so minutes as much as my knowledge into your head as I can, so that you can help your clients have freedom from capital gains tax, okay? And by the way, if you've been struggling, this is probably why. We call it the perfect storm that's going on. Crypto has crashed, right? Stock market's kind of shifting and maybe going down. Commercial real estate are kind of all-time highs. Even primary homes and things that are shifting and changing. You have some of the all-time highs maybe going through a massive switch. You also have the baby boomers, which represent about $32 trillion. I want you to think about this stat right here. So according to the American Bankers Association, there's about they first did a study about 10 years ago, 17 to 20 trillion. Now it's upward of 30 to 32 trillion. That's going to pass from the baby boomers to the millennials in the next 18 to 20 years. And this is known as the largest wealth transfer in the history of the planet. In fact, there's 10,000 baby boomers every day turning 65, and there's 77 million in the U.S. alone. And again, where you're located might be even the highest density of those baby boomers that have ultra high net worth wealth, okay? And so their question is, how do we transfer this without it being completely wiped out by the government taking it in taxes? You also have political changes, such as potentially taking away the 1031 exchange, or potentially eliminating the stepped up basis, or limiting that. You have a lot of change. Now, the 1031 is still intact, but it's still, they're looking at it, and they continue to battle on that. By the way, it's also not your fault if you've been struggling. Your CPA doesn't know about this, right? And part of why he doesn't know about this is because it's proprietary and to protect it, and we don't give our secrets away. But the other part of it is a lot of them aren't exit planners. I mean, they kind of look in the past and they do assessments on what you owe in tax, but they're not expert planners when it comes to capital gains tax experts. So this is our sliver. Like we don't do tax returns. In fact, we don't even do 1031 exchanges in that sense. We have a partner that does those. We just do the deferred sales trust. That's our one niche focus. As well, remember, 1031 exchange doesn't work for Bitcoin, NFTs, cryptocurrency, primary homes, business sales. And so it's just really tough, right? And by the way, the hard way, the 1031 exchange, what clients have been forced to do, they had to use the 1031 only for primary homes, but it didn't work for anything else. And I also want to talk to you quickly about the Delaware Statutory Trust, because those are beautiful properties, and they're typically managed by some really great operators. But what they force your client to do is to not have liquid funds, to not have diversification, and they have some pretty big fees. Okay, as high as 14% of every dollar is going to the multiple parties in between the real estate and the deal. You also have an old depreciation schedule, which is one of the number one reasons to own real estate is to have depreciation offset cash flow. But the biggest thing is you're selling high and you're buying higher in the same market. I mean, back to optimal timing. Our parents taught us to sell high and buy low, not sell high and buy higher. On top of that, I just put a property under contract, a $7.7 million deal at a 3.3 cap rate. The interest rate is like 4.5 they're locking in at, but now it's high as 5 to 5.5. And what's happening is there's an influx between what you can borrow at and what your return is. And this creates an opportunity for disaster for a buyer. Now the good news is I'm representing the seller here. I'm not representing the buyer. Now, the buyer is smart. They're going to be able to raise rents and increase the value, and they'll be able to catch up over time. But this is a situation where you want to make sure you're protecting your client. And if you're the client listening to this, that you're not overpaying and having influx relation between interest rates and cap rates, okay? And that's typically what's happening right now with all of the sales that are going on. So be very, very careful, okay? Now, there are some positives to the Delaware, okay? It's non-recourse loans. These are turnkey, beautiful Class A properties with amazing operators typically, right? First-class tenants. But here's the other caveat to that. They're typically not value add, right? Meaning they're typically turnkey. And I call them, sleepy, peaceful mailbox money. And for some of your clients, they may want that. But it's and there's no more management. I mean, they do all the management themselves. They do all of that stuff, right? And it can also solve mortgage over basis. And so there's some deals that we'll do a partial Delaware if they have a mortgage over basis. In fact, the $70 million deal Chad and I are working on right now for his client, he has a mortgage over basis. And so we're going to do a partial Delaware to solve that. Then the rest of it can go into the Deferred Sales Trust. Make sure you're working with our qualified intermediary, strategic partner, so you don't get caught not having that option. All right, so I'm going to walk you through how to help your clients now defer capital gains tax not using a 1031 exchange. But first, I want to just give you a few more deal stories. We did an Ethereum and Bitcoin case out of the East Bay. This client exited $5 million out of $50 million of Bitcoin when Bitcoin was at $54,000 a coin. Their basis was somewhere around $50,000. And so we were able to defer about $1.85 million of tax. She was ecstatic, be able to retire from the big tech company and also to start her own tech company using educational platform online, kind of like a Khan Academy. And those funds, the majority of these funds are used to do that business. All tax deferred, really cool. Here's another one for a seller. They did an Ethereum sale, a married couple, and they're mid 40s, and they're like, you know what? We're working 60, 70 hour weeks. He bought Ethereum. He bought Ethereum about $100,000. It went as high as $13.5 million. They went on to do $7.5 million with us, and they sold high and diversified. Now we'll get into a little bit of real estate here. So this is a primary home, luxury home in Palo Alto. Actually, for the number one, my client, he was the number one Keller Williams agent for over 25 years in Palo Alto, and he did it for his own house. He did a year and a half due diligence with his CPA out of the Silicon Valley to make sure this is all legit. He is my client. He did it for his own house, $8.3 million sale. He literally could not have sold without the Deferred Sales Trust because he had so much debt on the property and so much tax that after sale, he'd have nothing after commissions because he was representing himself. He'd have like nothing. He's like, without the Deferred Sales Trust, my real estate broker doesn't get paid, escrow doesn't get paid, I can't sell my house. He had six kids. The kids are all gone to college. He's just feeling trapped in his house. And so we solved that problem for him. He was able to relocate to Nevada, and that was a really powerful story for him. And let's see. The next one was actually in Colorado. And it was a $5.1 million multifamily sale. And we were able to eliminate the 40% death tax and defer all their tax. This is one in Sacramento for a client. He's worth about $40 million, and this is his first one he did with us. $3.1 million approximate sales price. He had about $1 million, zero basis. He did a partial Delaware, to get the mortgage over basis, and then he was able to defer the rest of it. All right. So what are the steps? We're going to talk about how here right now. Step one is just you want to map out a wealth plan and form the DST. So you sit down with Chad, myself, tax attorney, financial advisor. We would just map out and just what does this thing look like in your situation? Every situation is a little bit different, and we're going to map out maybe some investment allocations you might be comfortable with. Funds typically go to places like TD Ameritrade or Charles Schwab. But they can also go back to real estate deals, which is great. Step two is to transfer the assets to the DST, and the DST sells the assets. So in escrow, or prior to escrow, we're going to give you option language with Chad, the DST tax attorney team, to transfer or assign interest of LLCs or S corps to the Deferred Sales Trust, and at close of escrow, it can all transfer over. It's almost like there's two sales going on. The first sale is the seller selling to the trust. And then the trust selling to the ultimate buyer versus just typical sale, which would be the buyer buying just from the seller. So that's how that is kind of the simple answer there. Step three is we just fund the trust. And what your client receives is a promissory note. Okay. And the funds typically go to like TD Ameritrade. Okay. Now these promissory notes are typically structured around 5 to 8% compounded rate of return. They're typically 10-year notes, and they renew every 10 years for 10 years. But really the transformation happens or the achievement for your client is they can enjoy your wealth, their wealth more. They can give more if they want to, but there's no charity required here. They can invest, they can start a new business venture. They can even invest with you if you have other deals, okay? They can also always just be cashed out and they can pay their tax, so they're not locked in it forever. People want to know how I got out of it. They can also pass it on to their kids, and their kids can continue the tax deferral, which is really cool. The best part I think about this is they can also invest in investment real estate whenever they want by partnering with the DST. Okay, so how does this all work? All right. So Chad, are you ready to you don't have a live Jeff, do you have any live deals going on that I can kind of illustrate here for us right now?
Let me think if any of the ones we have would have that situation. I don't think they'd be at that qualification level.
Well, we've got one right now on Whitefish Lake. The owners of the property bought it for just slightly over $1 million. And I brought them an offer for $5 million 3 years later, just recently. And they don't want to deal with a 1031 and they don't want to deal with capital gains.
Perfect. There we go. We'll use that. Okay. So $5 million is the sales price, right? And about $1 million is the basis. Okay. And we're just going to use zero debt just to keep it simple. Okay. And so there's about a $4 million gain. So on that $4 million gain, we're going to use 30% as the number here, although California would be like 37, but we'll use 30% on 4 million. So they're looking at 1.2 million of tax, okay? So this is what we want to try to solve for. All right, so step one is you list the property to sell, okay, for 5 million, and you find a buyer, and they could have cash or they can get a loan. Doesn't really matter if they come with cash. But the point is, we're not going to finance the buyer. They're going to come with the full $5 million. But Chad, what happens if the $5 million goes directly to the seller? Do you see how this would trigger the tax here?
Yeah, it's actual construction.
Yeah, so we're not going to do that. In fact, imagine this was a 1031 company right here, right? And if the funds went to the 1031 company, they don't go to the seller's hands, then guess what? It's deferred, right? So I want you to think of the trust kind of like a 1031, and that's exactly what's going to happen. In fact, the assets are going to be sold to the trust for $5 million and immediately turned around and sold to the buyer for $5 million. Okay? The cash buyer is going to put the money into the trust, so the $5 million sits here. But Chad, if the trust bought and sold for the same price, how much gain does the trust have? Zero.
Well, zero on the tax bill.
Yeah, you see that on that one. And if the seller carried back a promissory note, right? They didn't take any cash. See that? They carry back a promissory note for $5 million. Right, an installment sale. How much cash is triggered if they haven't received any of the cash yet?
It's not.
You got it. So this 1.2 million is in a deferral state. You see that? So do you see how you just added $1.2 million of value for this client? Isn't that pretty cool, right? So their closing statement, instead of having, although they won't pay the tax right at closing, they'll pay it the next year. They're not paying 1.2 million. They're able to defer that. Now you might ask, well, what is the government charging on that? They charge 0% on this 1.2. So they still owe the money to the government. It's just in a deferral state. Just like if they went to a 1031, the money is still owed. It's just in a deferral state. It's not triggered today, and the government charges you 0%. So let me ask Jeff. Jeff, if the government gave you a loan for 1.2 million, it said as long as you invest it into real estate and stocks, bonds, and mutual funds, and you can live off the interest, when would you want to pay that loan back?
You take your time.
Yeah, never, right? Never. And so these notes are structured typically at, for the full 5 million at 8%, typically, okay? And that includes this extra 1.2 million. And so that cash flow on that is about $400,000. Now, if you receive that cash flow, which you can receive it. You can also defer some of this. Okay, you'll pay tax on this. You'll pay ordinary income tax on that. But guess what? There's an extra 1.2 working for you. You see that? Mm-hmm. So anyone have questions on what just happened here?
Question is, how long can you defer it? Yeah. Is the most common. Yeah.
Every 10 years for 10 years, you can renew for 10 years and for 10 years and keep renewing for 10 years. So it just keeps going, and you can put it inside your living trust, and kids can keep doing it. And we're just going to keep this thing going. So most of our clients will just keep this thing going. So we're structured at 5 million, 8%, typically a balloon payment due in 10. But then what we do is we just renew it. Okay. Renew it. It's a balloon, but then we renew. It's kind of like refinancing a house, right? The bank says, you owe us all the money. Then you just keep refinancing. So these are typically interest-only loans, right? 8% interest only. Clients can live off 4%. They say, I don't need all 400. I like to take a $200,000 distribution, and let's let the other $200,000 just compound and build, right?
The other thing that I think is important here, Brett, is the other utilitarian uses of that $5 million, so that you don't get in a 1031. So in that $5 million, you can borrow against that $5 million to buy other investment properties or other investments or start a new business.
Yeah, little caveat there. Yeah, you can't borrow against it, but what you can do is JV partner with it. Okay, because if you borrow against it, it'd be taxable. Well, let's just walk through that scenario. There's 5 million here, and there's an apartment complex, and let's just say it's a $4 million apartment complex. Okay, the trust, up to 80% of it can go buy this apartment complex with you. Okay, and the way we do that is we form an LLC, and this LLC partners with the trust. And it gives you 80% ownership. So if this was Chad's deal, he'd be an 80% owner. But Chad puts up no money. And the trust puts up the $4 million for 20% ownership. Okay. And it asks for an 8% pref, the way we structure it, to keep it commercially reasonable, an 8% pref. But so it's kind of like borrowing from yourself, right? Here's the key. It's kind of like, but if it was borrowing, it'd be taxable, but we don't. It's a legitimate business investment opportunity, and you go buy this property, and the property goes to 10 million bucks. What happens is an extra 6 million. The original 4 million goes back to the trust, but remember, it owes you the money anyways. Right? On that 4, and this extra 6 million can be split 80-20. 80% of the 6 million can go to you, of which you can add that to another promissory note. The other 20% goes to the trust, which, depending on how much has been returned, is going to pay you. So yeah, there's a creative way to do that. All tax deferred. There's a lot of arrows there, a lot going on, but yeah, that's the deferred sales trust. You can partner with it to buy real estate all tax deferred. That's what the guy did, the Monday morning quarterback. He did that for the Minnesota property.
And that's what we're dealing with on this $70 million project. He's got two of them, so it's 140, but he's got about $16 million capital gains on each one. And by setting this up, the deferred sales trust is the way that he's looking at it from a high level view is, well, I'm just going to treat myself as the bank, the money the 16 million that I would have paid in taxes, I'm just going to look at as using as my bank and joint venture in my future projects.
Exactly. Yeah. So you think of it like a bank, but it's a joint venture. Exactly. And so we call it the go fund yourself. Instead of having to get funding from a bank or funding from partners, the trust can be that business partner with you. And so what investors or clients used to have to do, they had to stay in millions and gain in real estate, right? Businesses or crypto, not sell. They had to borrow against their properties or their crypto. They had to give it all away to charity. They could, not sell a business or stock or primary home, overpay for a 1031 new property, more time, energy, toilets, trash, tenants, employees, and liability. They say they become the lender for the single buyer, because someone might say, well, why don't I just loan it to the single buyer? Well, a traditional installment sale, they're typically short in nature, 3 to 5 years. They're going to pay you back anyways. They're typically around 5% interest. And they're typically not investment grade people, meaning the person that you're betting against may run your property into the ground, right? Why not diversify, get liquid, putting in some of the biggest companies in the world and other investment real estate that you can go make more money on rather than sitting back with a single buyer? They used to have to stay in debt, time, energy, and stress and pay the tax, which is not great, or not list the property with you. So the deferred sales trust can help you solve your clients' cap gains tax problems. And it's really simple. The plan is this: form a DST, transfer the funds, transfer the assets to the DST in escrow, you guys list and sell the property, defer the tax, fund the trust, and invest with the trust. And the answer is anytime, optimal time. Now, we do need to set this up prior to the close of escrow, even like to set it up prior to the listing as much as possible, but definitely prior to the buyer removing all contingencies, unless the property is 1031 eligible, and then we can do it at a qualified intermediary. But the best way we help people to close this is to educate all of your clients right now and then set up the exit plan before they're actually listed with you. Because if you do it in reverse order, it's really difficult sometimes for people to, under the strict timing and the buyers removing contingencies, it's all going fast, to get as comfortable as they could be if they just had set up a month prior to. So we've closed deals in 5 days, 7 days, 14 days, 72 hours, but nobody wants to work under that fire drill. Now is the time to educate. This is part of why we work on a conditional basis. So, we won't be charged. We won't, the deferred sales trust, myself, we work on a conditional basis where we won't charge you unless you close the deal. Okay. So, that is it. I want to open it up for questions. I don't have a link for a survey, but I'd love your guys' feedback, so we can be better for you the next time. And if you want to take action, you can go to deferredgains.com. This is with Chad, and it goes to his Montana Law Group website. And that'll give you a chance to see if the deferred sales trust is a good fit. With that being said, I'm going to pass it back over to everybody else. Maybe start with Jeff. Any thoughts or feedback, Jeff? And then as well, open it up for questions for anybody else.
Yeah, thank you, Brett. One of my questions, I think you've answered it, but you can perform or put one of these together within a few weeks if you need to, is what I heard you say? Yeah.
Yes. Yeah. As long as the buyer hasn't removed all contingencies, Jeff,
Okay.
we absolutely can.
What's that bearing on it? Why does that matter if contingencies are in play or not?
Okay, so there's an idea called, or it's a law, constructive receipt, which basically means if the buyer has removed all contingencies and there's nothing holding up the deal itself, just a couple days before the money's transferred, then that's what's called constructive receipt. It's too late for the trust to come in. There's a thing called the binding commitment test, which basically means can the buyer compel the seller to close. And if that's the case, it's too late because the trust at that point
They're bound. Okay.
Yeah, it's not coming in the proper time. So the key is just do it. They could have financing continue. It could have, it could have any kind of like just something that's holding it up. The buyer is waiting to remove. Then we insert the trust. The second thing would be sometimes buyers, if it's last minute, they go, well, what's going on? Well, the way you explain that, you say, well, if they were doing a 1031 exchange, it's or a deferred sales trust, it makes no difference to you. You get everything you bargained for. It doesn't change any of the nature of what you're receiving. You're receiving clean, clear title. That's all fine. And even more so, you actually want the seller to defer his tax, because should they not represent something properly, they actually have money to pay you, right? Versus just paying it all in tax or spending all the money. In essence, the deferred sales trust encourages people to save and defer. Anytime you spend from the trust, you get taxed, right? Or take distributions and spend it on personal stuff. It's also important to understand that this can't go back into a primary home, tax deferred. So if someone is selling a $5 million primary home and wants to defer all of the tax, right, then that's fine. And all of the investments can be everything but a primary home. It's the same reason you can't 1031 into a primary home, right? You need to be able, it can't be for personal use. It needs to be investment or business purpose. Part of why the IRS gives us, we believe, these types of tax codes to use, like the IRA or the 401k or the 1031, is to incentivize the market to move and money to be changed hands, and new property tax valuations, new investments. It's a study of macroeconomics. With the more cash that can roll through business and investment, the more the economy grows and more jobs are created, which ultimately leads to more tax revenue, right? So this is why these things are really important for just the general economy. But the caveat to that is you can't just spend it on personal stuff or a primary home, because that's taxable. Does that make sense, Jeff?
So my follow-up question or second question is, once you've set up a trust on a transaction that happened, whatever it might be, can you then do other transactions and lump them into that same trust?
100%. Yeah, that one trust, it's going to be multiple promissory notes. So we did $100 million on 5 transactions for 2 multifamily syndicators, each GP interest over the last year and a half alone. So they each have one trust, and every time they sell their interest in those assets, they just roll it into one trust, multiple promissory notes.
And is that $1 million limit still in play for additional ads?
So once you're at 500 and 500 each, and you got that million, it starts to scale a little better. But like I had a call the other day, and I got 25 houses that are worth $2 million, and I'm like, can you get a buyer can you lump them all together in one transaction? Is it in one LLC or one transaction, and do it all at once? Because the transactional cost goes higher and it becomes a big mess. So just practically speaking, Jeff, bring us the case and we'll look at it on a case-by-case basis. But a good rule of thumb is $1 million net proceeds, $1 million gain. If it's a primary home, you want it to be probably like 1.5 or 2 or 2.5 million. You want a big enough, because that 121 exclusion, if you live there 2 of the last 5 years, you get 500 tax-free if you're married, 250 if you're single. Does that make sense, Jeff?
Yep. And then my last question is, for instance, I'm thinking of a situation, we're going to be listing a property that has 2 sisters that inherited it. Could they form an LLC or a group and then put this together?
Yeah, they can. So each partner can go their separate ways. The whole entity doesn't have to move like a 1031, and it's very seamless. So we just did a $13 million deal in San Diego. There was 4 partners on a car wash sale. One of them just paid his tax. The other 3 used the deferred sales trust, and each of them have their own trust separate from everyone else. It severs the partnership and keeps them separate. They could also go repartner again through the LLC, a method, but that's a great way to separate. Each could have their own, or each could go their separate way.
Or do it together if they choose to.
Yeah, well, we wouldn't have them do it one trust together. We'd have each family unit. So each married couple or single person would have their own trust for a number of reasons. But yeah, they would just split their proceeds into each one of them.
Okay.
Would you mind you touched on a little bit before, but the benefit from the inheritance or estate tax benefit? Yeah,
estate tax is huge, right? So what's the problem? The problem is any of your clients that are worth 22 million married or 12 million single are subject to a 40% death tax on their entire estate, regardless of a stepped up basis or a 1031, right? Some people get that confused. They go, oh, I'm getting the stepped up basis, therefore I don't have tax. Well, your kids won't have capital gains tax. That'll be stepped up basis if you held on till you die. However, the estate is the entire amount. So I'll give you an example. My client, we just did the $5 million deal in Colorado. They're worth $25 million, and all $25 million is inside their taxable estate. So the first question you ask your client is, A, what's your approximate net worth? And they say $100 million. Okay. Of that $100 million, how much is inside your taxable estate? All of it. Okay. Are you married or single? I'm married. Okay. So we can minus 22 million from that 100 million. That gives us 78 million. Now take 78 million times 40%. 78 million by 40% is $31 million. So Mr. Client, do you understand that even if you die tomorrow, and I don't want to talk morbid stuff, but you do, and $100 million gets stepped up, but your estate is all inside, that your kids are going to have to pay $31 million? And they're going to say maybe yes or no, or I know, but I've been trying to give away to charity, or I'm trying to gift it away. Well, we have a solution for you. It's called the Deferred Sales Trust Plus. We can sell your $78 million of real estate today, and tomorrow it'll be outside the taxable estate. We've literally changed the nature of it, okay? We didn't buy any life insurance. We didn't give any away to charity. We didn't have to. You can if you want to. And we're done. Like $31 million. So to me, like that is better than almost anything else that we've said here, because it's nothing else can do that. Does that make sense, Chad? Does that answer your question?
Yeah, it's great. And the illustration of that is what we see, especially in Montana, or third, fourth, fifth generation families that bought their ranch for, a bottle of whiskey and a donkey, and now it's worth 20 or $40 million. And the parents that are currently holding it have children that don't want to take it over, and they don't necessarily want to sell, but they aren't planning ahead for this inevitable tax hit. And so when the kids ultimately inherit that ranch, they have a very short fuse to pay this tax, so they're forced to sell the ranch. Yeah. So if you do this tax planning in advance, as the sales pitch to get this listing, this is something that you can help your children avoid and to keep the ranch. Mm-hmm. If need be.
Well, you got to sell the ranch, right? You got to sell the ranch.
Right.
You got to sell the ranch in your lifetime before you die, and you got to sell it to a third-party buyer. It's not like you're just transferring the ranch into the trust. Right. You got a third-party buyer for $100 million to buy the ranch, and you got the trust set up in between. And instead of receiving all the $100 million at close and having to pay the tax, it's going into the trust, and then the beneficiaries are the kids, and they inherit it outside the taxable estate, versus just selling and saying pay. Most people won't even sell it because of the capital gains tax. So we solved those problems, and it's a powerful thing. So to finish the Colorado story, there were 25 million. Their primary reason they used the DST was for this reason. All 25 million is inside the taxable estate. So they sold the multifamily asset, and they moved the 5 million outside the taxable estate, which immediately eliminated the $2 million estate tax. So that's huge. It's elimination. It's not even deferral. It's elimination of the estate tax.
Okay. And I just to be clear, there's not so this all goes into the trust, and then a few months down the line, there's an opportunity, a business opportunity. There's no limit on how long money can go out then at that point.
Yeah, we go the next day. We have clients, they're literally closed, and the next day they formed an LLC. The next day the funds are transferred, and they go buy that business opportunity or that investment property. Yeah, it's that quick.
Okay.
We do need to keep 20% liquid investment grade securities, diversified, right? So we can't put all 100% out. That's something to talk about. By the way, real quick on the legal part, this is important. I don't know if we really touched on this, but thousands of closes, billions under management, over a dozen no-change IRS audits. It has a private letter ruling. It's literally batting 1,000, additional 3 formal audits from the IRS. The tax attorney, who's my business partner, he provides lifetime audit defense, state or federal, okay? 26-year track record. It's literally perfect. It's never lost. You'll search online, and there'll be 1031 exchange companies that are bloggers, and you swear they've done 1,000 of these, right? They're like experts. They make these statements that like the DST doesn't work, or it's not legal, or the franchise tax board sent this notice, and it's like they take everything. It's like the drive-by media, right? They take it out of context, and we're literally batting 1,000. It's perfect. Okay, so the CPA is going to be skeptical. That's fine. Bring them to the table. 9 out of 10. I'd say 99% of them join us once they spend time with us, right? And so I'd encourage you, just bring the folks to the table to meet with us, to get educated. And we have the evidence, we have the track record, we have the client references, we have it all. I have a YouTube channel as well. You can check that out, Capital Gains Tax Solutions. We have the book that's coming out, or that's with Kevin Harrington from Shark Tank, that's coming out soon. So take a look at that. But really go to deferredgains.com to get with Chad. Roll through Chad first, and then Chad can get with me, or just CC Chad and I as your deals are coming up, so we can all work together on it, if that makes sense.
Yeah, so it's again real simple. This isn't something that you have to memorize. You're kind of picking up the sales pitch of it, or the loop of it, in reference to 1031 with the clients. And as long as you can understand that in general and give that to them, and it piques their interest, then you can just drive their attention to the deferredgains.com. And it's the same information that's in this packet. There's 15 or 20 videos of Brett and myself doing presentations, answering. There's an FAQ, there's a fee schedule in there. And at the bottom of it, if they're interested, there's a link for them to fill out a free questionnaire for an analysis. And we'll provide that for them within a quick period of time. If you or your client have any questions prior to even doing that, we're more than happy to jump on a Zoom call or a call to answer any of their questions.
All right. Anybody else? Anything else?
Okay. Well, Brett, we really appreciate your time today. That was very enlightening and certainly has my wheels turning, and we appreciate you taking the time to tell us about it.
It's been my pleasure. It's a pleasure to meet everybody. Let's go help a lot of people together. And I'm here for everyone and connect with Chad and I. Thank you so much for the opportunity, and happy to come back too every now and again to give you guys the refresher. Okay.
Okay. Great. And thanks for hosting the call.
Yeah.
Absolutely. Thanks so much. I have the recording too. So yeah, I'll send it to Chad and you, Jeff. Okay.
That'd be super. Thank you.
Okay.
Thank
Bye
you.
now.
Thanks, Brett.
Bye.